Hello everyone, Assalamu alaikum. Can you please reply me about the clarity of my voice? Hello, Assalamu alaikum. Can you please all reply me about the clarity of the voice? I hope that all of you people are doing good. You can reply me on the platform or the WhatsApp group as your wish. Sorry. Yes, handouts will upload very soon on this platform. Don't worry. I'm going to share you on the WhatsApp group as well. Okay, one moment, please. B to B. Yes, the webinar is going to start now. Bismillah Rahman Rahim and Assalamu alaikum once again to all of you. Now we are going to start the session formally, and today we will start the session with an accounting standard with the examiner regularly examine. That's the IAS 12 taxation. IAS 12 taxation, and afterward we will discuss the IAS 19 and some aspect of the performance measurement as well. That is what the today's agenda. We'll discuss a little bit about the IFRS 9 if we have spare time. Otherwise, we will discuss IFRS 9, IFRS 15 by tomorrow with the conceptual framework. That is what the complete agenda. Okay, candidates. Candidates, I hope that you people are getting the benefit. I hope that you people getting benefit from this particular ACCA P2P session December 20, specifically for the purpose of enhancing the confidence. This is not the way of the traditional methodology of the P2P. That's only revision of the limited standards and the limited topic. That is about how to handle the exam questions. That is about how to handle the exam questions. That is what the actual bridging the gap between the examiner expectations and your delivery. So that is not about only a quick briefing. It's about the actual gray areas, actual issues from where the examiner complaining that, and I've identified these things from the examiner reports, all these things, and read the mindset of the examiner that what the particular mistake you people do. Okay, candidates, now it's a start for the working, and and this one is about, okay, Bismillah Rahman Rahim. Sorry. Candidates, there is an accounting standard that's called taxation. A quick background, of this particular standard. A quick background. Number one, this handout is a very comprehensive handout for the exam purpose. So you can use that particular handout, uh, and this is good enough for your upcoming exam. No need to go where any other place. you just use that particular. Candidates, listen carefully. IS 12. Taxation. What the background? What is the background? A quick background of the 1 minute. 1 minute quick background. For example, we have year end 2019. For example, we have a year end 2019 and we are preparing the income statement. And preparing the income statement, sales, moving forward towards the profit before tax. Profit before tax. And we have done all the working about the income statement or the accounts and now the turn is taxation. What the amount of taxation should we report in the published accounts of 2019? That is the task. That is the task. What should be the amount of the taxation for the published accounts? So do remember that whatever the income and expenses, the income and expenses we report in the income statement, that should be parallel with the accounting standard and the accounting principles. That's called the conceptual framework. All the income and expenses must be parallel with the conceptual framework and the accounting standard method. So definitely this taxation should also be reported according to the accounting concept. According to the accounting concept. That is the key point. So a very basic thing. If we want to calculate this amount of taxation that's need to publish, what we do first, we go for the calculation of taxable income. Go for the calculation of taxable income. Taxable income. Where we pick the profit before tax, so-called AP accounting profit. Let's suppose 10,000. And then we adjust the figures according to the tax matter. Something allowed, disallowed, allowed, disallowed. And then we identified a figure that's called the taxable income. And let's suppose the taxable income become 9,000. Let's suppose that's 9,000. And our tax rate, that's 30%. And then whatever the amount calculated based on taxable income. Taxable income means the profit calculated by the tax authorities. Whatever we estimate amount, that's 2,700 based on taxable income. That is called current tax. That is called current tax. But the question is that should we only report this current tax in the taxation figure? The answer is no. The answer is no. So what will be the answer? The answer is that the tax expense must include the current tax. The current tax is actually based on taxable profit. But one more need to incorporate, that is called deferred tax. Sir, what is the meaning of deferred tax? Deferred tax means, let's suppose this difference arises due to 1,000 income. For example, this is interest income receivable. Interest income receivable. And accounting standards say, sorry, tax authority says, whenever this income received on cash, we will accept this income. Whenever this income received, we will accept. But right now, accrued income, it's not taxable. That's why we minus this 1,000 and it's become 9,000. So I have a very simple question with you. Very simple question. Can we say that we have saved the tax? Can we say that we have saved the tax? Can we use the term save the tax? Answer me, please. Answer me, please. Can we say that we have saved the tax? No. No. It's not saving. It it's better to say that it's deferred. It's deferred. It's deferred. Means, listen carefully. It means some of the income we have earned. What we will say? We say that the income, that's interest receivable, debit interest income credit, that is 1,000. If we book the income which is not yet received, then later on we have to pay the tax. So the later on that we have to pay the tax, that is called deferred tax. And the entry should be income statement charge, and deferred tax liability should be credited into 30%. That's 300. So that is what current tax and the deferred tax. I must repeat, I need to repeat one thing. Actually, we want to report this taxation based on the accounting principles of normal income expenses. This tax is not only based on tax authorities. So if we adjust our current tax, sorry, if we adjust our current tax, if we adjust our current tax, if we particularly adjust with our current tax, what we will say that we must have to say that, sir, sorry, if we need to adjust the current tax, adjustment for the total tax expense parallel with the conceptual framework, then we need to put the deferred tax adjustment. Then we need to put the deferred tax adjustment. So candidates, a very important thing you have to consider that whenever examiner says that what is about the taxation, so you must say that taxation is basically reporting of the current and deferred tax. You have to mention this. And the issue of the current tax is actually about the temporary difference. The temporary difference. The issue of the deferred tax must be based on temporary difference. It's not about the permanent difference. Temporary difference means there is a difference of income and expense between the tax authority and accounting, and that will be settled in future. Means in accounting, this income we are accepting now, but tax will accept this income later. Means tax and accounting will be parallel, but later on. That is timing, temporary. Furthermore, furthermore, there are two methodologies for the working of deferred tax. There are two methodologies. Listen carefully. For the purpose of the writing, this working is very important. Listen carefully. There are two methods to calculate the deferred tax. One is called income statement method, and another is called balance sheet method. Always accounting standard prefer the balance sheet method. Always accounting standard prefer balance sheet method. What does that mean, balance sheet method? Balance sheet says, for example, you are finalizing the 2019 accounts and you have preparing the income statement, you reach that profit before tax. And someone says that now it's time for deferred tax. First of all, you have to make your balance sheet, but unadjusted. Unadjusted means without the adjustment of deferred tax. And you have to work out all the assets, asset 1, 2, 3, 4, 5, 6, all the liabilities, 1, 2, 3, 4, all asset, all liabilities. And whatever the balance sheet you will make, that's called carrying amount. And then you will make a list of carrying amount versus tax base. Carrying amount means accounting values as above. Tax base means asset and liability according to tax. For example, let's suppose interest receivable, carrying amount 1,000. But tax authority says that we will not consider receivable as an asset. So tax base nil. So that means there are some temporary difference. For example, plant, cost, depreciation, 1 lakh cost, depreciation 10,000. Here 1 lakh cost, but depreciation, let's suppose 5,000. So there is a difference. That's 90,000. That's 95,000. Like here, the difference of 10,000. Here, the difference of 5,000. These are assets. Same case candidates for liabilities. For example, accrued expense. For example, provisions. Let's suppose you record an accrued expense of 200. That means we are putting expense in even not paid, the accounting principle. Tax authority says no, accrued is not allowed. So tax base nil. Once again, difference. Same case for provision, like same. So actually, you have to remember in your back of the memory that always deferred tax calculate on the basis of balance sheet means the difference between accounting and tax. And this statement is very much important for you. Deferred tax balance sheet approach, temporary difference. And this should be categorized as follows. The temporary difference arises due to the reason of asset and liability. Asset, there are two cases, liability two cases. Asset carrying amount exceeds tax base, like this case. Asset, interest receivable, carrying amount exceed tax base. If this is the case, that's called taxable temporary difference. One moment, we can change this manner in this point. Asset, there are two difference. One name is taxable temporary difference. Another name is deductible temporary difference. Two case, asset, liability. Asset, liability. If asset carrying amount exceed tax base like above, we will call taxable temporary difference. And for all taxable temporary difference, we will book deferred tax liability like above. If liability carrying amount less than tax base, once again, taxable temporary difference, book deferred tax liability. If asset carrying amount less than tax base, that's called deductible temporary difference, called deferred tax asset. And in case of liability carrying amount greater than tax base, deductible temporary difference, that's called deferred tax asset. This must be in your mind. What should be in your mind? Your mind should say that for all taxable temporary difference, book the deferred tax liability. For all deductible temporary difference, you book deferred tax asset. That's important. That's the background. Your examiner can ask this one, the principle. What is current tax and what is deferred tax? Basic principle of deferred tax. I have given you this lecture because if examiner asks you 6 marks, what is the principle of the deferred tax? You must have an ability to put your answer in this manner. In this manner. This one, this one, this one. The theoretical aspect. That is what how to write the answer. Can that is you can write it exactly whatever I have said to you. I have put it on the page number 3 and 4 with an example. Candidates, listen carefully. A limited structure I will discuss with you. A limited structure. A particular and specific case. The examiner very regular examine about the deferred tax asset. Before that, now listen carefully. Listen carefully. This is a very critical point. This what I'm saying to you that it's very much critical here to understand. I don't want that you people just mug up the things. No, rather than you have to understand the things accordingly. Although the time is very much limited, but I'm trying to put my best effort. Now, listen here, listen here. Very important concept. Number one, if the case of taxable temporary difference, please, I need your proper attention. The case is, if I say, sorry, taxable temporary difference, where you book taxable temporary difference, where we book deferred tax liability. What is the case about? What is the case about? 2019, let's suppose an example. Accounting profit, AP accounting profit, 10,000, and taxable profit, TP, taxable profit, 9,000. So what is the reason of the difference? The reason of the difference is this. There is 1,000 interest income accrued. There is 1,000 interest income accrued. Okay. So taxable, listen carefully. Taxable temporary difference arise where now accounting profit is higher, taxable profit is lower. Right now. Right now. Accounting profit is higher, taxable profit is lower. But what if, answer me, what if in 2012, when cash receive, what will happen? Accounting profit will be lower, but the taxable profit will be higher. Yes or no? Answer me, please. Once that interest income will receive in future, taxable profit will become increases. Please reply me. Don't worry. Don't worry. You will get the material. Don't worry about it. Just a moment. Just a moment. Please share the material. Okay. Listen. Yes or no? That it will increase. Okay. That's first thing. That's gone. That's first thing. That's gone. Now, another point. Listen. Deductible temporary difference. This is for the important point. Where we book deferred tax asset. What will be the case? What will be the case? Listen carefully about the case. Don't mix the above case. It's a separate one. Just a minute. Just a minute. Just a minute. Okay. Deductible temporary difference. Deductible temporary difference. Where I say that, let's suppose I'm saying that one moment. Okay. Deductible temporary difference, for example, accounting profit is 10,000 and taxable profit, let's suppose 11,000. The difference is 1,000. And this is the game of 2020. Don't mix with above example. And the reason is that we have booked an accrued expense. Expense debit, accrued liability credit, 1,000. And here the case is that accounting tax profit is higher and accounting profit is lower right now. But in future, listen this statement very carefully for exam purpose. In future, 2021, next year or afterward, this expense will adjust if some taxable profit arise, because the chances that taxable profit reduce and accounting profit increases. This expense only adjustable in the next year if some taxable profit arises. If if there is no taxable profit next year, we cannot adjust our expense. So candidates, listen. Accounting standard says for all the taxable temporary difference, book the deferred tax liability. That's all. But for deductible temporary difference, when you book the deferred tax asset, when you need to book the deferred tax asset, make a check. Make a check. And do remember that in a complete accounting standard, whenever you are going to book any asset, always accounting standard making some conscious approach. Conscious approach means wait, hold. If you are going to book asset, check that. Is it possible that future economic benefit will exist from where you can utilize this asset? What is the meaning of asset in conceptual framework? Asset, generally asset, future economic benefit. Future economic benefit. So if you are booking deferred tax asset, you need to assess with respect to conceptual framework, assess that either expected that future economic benefit will arise, and for this purpose you need to assess either there is a chances for next year the taxable profit arise from which we can utilize the deferred tax asset. That is what the principle of deferred tax asset. That is what the principle of deferred tax asset. This is what the principle of deferred tax asset. This is the principle. Read it carefully. One moment. Yes. Sorry, candidates. Okay. Read it now. What accounting standard says about the deferred tax asset? Yes, this is a very common thing examined in the examination question. Deferred tax asset. You must have to write it. A deferred tax asset must satisfy the recognition criteria given IS 12. And what a standard says, deferred tax assets should only be recognized to the extent that probable that future that taxable profit will be available against which it can be utilized. And this is what the prudence conceptual framework. And you can write it. When can we assure that sufficient taxable profit against which deductible temporary difference can be utilized? And you have write this answer. I'm not reading right now. If due to the reason of the COVID-19, insufficient taxable temporary difference, examiner can examine this. For example, this is COVID-19 situation. We wanted to book deferred tax asset, but we are expecting that future not enough taxable profit. Where there are insufficient taxable profit, deferred tax may only recognize that it is probable that taxable profit will be sufficient, same as the future taxable profit. And continuously you need to reassess. Continuously you need to reassess. That what reassess? For example, we wanted to book deferred tax asset 100,000, but we have at that point we need to assess. Once we assess that, we have identified that we can only book deferred tax asset 40,000. Okay, do it now. Next year, the situation will need to reassess. Should the situation revise? We need to enhance the deferred tax asset or not? Maybe the situation will be more clear. Candidates, one application of deferred tax asset, one application is related to unused tax losses. Unused tax losses. Application. You can apply the concept of deferred tax asset with unused tax losses, credits, carry forward losses. What does that mean, sir? It's very simple. If we earn some taxable profit, we have to pay the tax. But if we have some losses, we have some losses. Yes, hold on, please. Just couple of minutes after, we have a question, exam question. Don't worry. Now listen. For example, 2019 accounting loss of 100,000 and 100,000 one accrued expense not allowed by tax authority, not allowed by tax authority, that is 10,000, and leave it accrued expense, and this accounting loss equal to taxable loss, let's suppose 100,000. Normally if we earn the taxable income we have to pay tax, but for tax losses what tax authority says, tax authority says that okay, you got a loss by next 2 years, that is 2020 and 2021, two time periods, next 2 years, even you earn profit, if even you earn taxable profit next 2 years equal to 1 lakh, no need to pay tax, no need to pay tax. So number one, our standing here 2019, we got a loss, government has permitted us, that's no need to pay tax if you earn taxable profit of 1 lakh. So this benefit we can book as a deferred tax asset. We can book as deferred tax asset because it is the expected future benefit that even we have the taxable profit but we will not pay the tax. But the important point is that whenever we book the deferred tax asset, we need to assess that either we are able to earn this taxable profit or not. If we are not able to earn the profit of this taxable profit, we cannot book the deferred tax asset. That is what the accounting standard says. What accounting standard says? For tax losses, read it. Future taxable income, if allowed by tax authority, that's called future tax savings, future benefit. You have to book the deferred tax asset if taxable income expected. And this statement is critical. A deferred tax asset recognized for carry forward unused losses or credit to the extent that probable that future taxable profit will be available against which unused tax losses credit can be used. It is probable that future taxable profit available not. How can this probability assess? So accounting standard that the factor need to consider that probable future economic or not. These four factors you have to write it. Just write it. Sufficient taxable temporary difference. Tax losses arose, for example, COVID-19, unlikely to occur. Probable sufficient taxable profit for unused tax become expire, and tax planning opportunity. You don't have time to put the extra effort for this explanation 1, 2, 3, 4. But you have just put it. Sir, how this matter can examine candidates? March, June 2019, question 2. Come on, let's do it. How the examiner examined in March 2019. Candidates, can you please reply me? Is my voice clear to all of you? Okay. First of all, focus this deferred tax asset. Now read it. This is what the ethics question that we were discussing last night. This is what the question about. An extract of the question. Deferred tax asset. Stent company includes deferred tax asset in a statement of financial position based on losses incurred in current and previous 2 years. Previous, huh? Finance director has asked the accountant to include deferred tax in full. He suggested this on the basis that Stern company will return to profitability one funding issue resolved. And that is what the case about. That is what the case about. First of all, we put the knowledge. In accordance with IS 12 income tax, deferred tax assets shall recognize for carry forward unused losses to the extent that probable future profit will be available against which unused tax losses can be utilized. This is what the principle that you have applied the knowledge. However, existing of unused loss, strong evidence that future taxable profit may not be available. Therefore, entity has a history of even losses. Entity recognized deferred tax asset arising from unused losses only to the extent that it has convincing evidence that sufficient profit will be available against the unused losses can be utilized. In this question, we have a series of previous losses. And if we are going to book the deferred tax asset debit, P&L credit, that's profit enhance. Equity increases. So if we are still in a chaos, for example, if I am asking you in the Europe, someone getting the loss due to COVID-19. So what do you say that? The COVID-19 of 2020, answer me, COVID-19 of 2020, what information you have about the UK and the Europe? Will it be recovered for the next year? Is this expecting at the date of December 20? Are they recovering the position in the USA and the Europe? What's your opinion? Please reply. If the UK based company right now saying that we are continuously lost since 2020 COVID-19 and book the deferred tax asset, but we don't know what will the situation will happen next year. So is that the right way to book the deferred tax asset? No. Deferred tax asset only booked to the extent that if we are expecting future expected profit, future taxable profit. The examiner can examine this point in that manner. That's why I'm discussing this point. In such circumstances, amount of deferred tax asset and the nature of evidence supporting its recognition must be disclosed. Director of the company should consider whether probable that the company will have a taxable profit before unused losses or unused credit expire. When unused losses result from identifiable costs, which are unlikely to reoccur. This is the factor that I've discussed with you. Taxable losses arose unlikely to occur. That exactly exam solution mentioned. and whether tax planning opportunity available on the entity which create taxable profit in the unused losses or unused credit can be utilized. To the extent that not probable that taxable profit will be available against which unused losses, unused credit can be utilized. Deferred tax asset shall not be recognized in this case. If director says that, do record, because previous question, September 19, this is the question about the ethics with performance measurement. What the impact of performance measurement? The removal of deferred tax asset would reduce net asset and equity, and gearing would increase. That we can connect accordingly. Candidates, that's the quick briefing of IS 12 and how the examiner has examined. I strongly recommend all of you, you must have to attend these two questions as well. Specimen 2, question 1B, and self attempt. And September, December 2019 question. This one already done. Sorry. This one done. Specimen 2, question 1B. That is a what we have done. Candidates, are you people with me? Please reply me accordingly. Thank you very much. Candidates, next one. Although examiner haven't examined the law, but this is another important point. Deferred tax and group scenario. I am just giving you a brief. I don't have enough time to connect with the exam question, but I have mentioned in the notes below the questions. But I'm going to a quick brief. You just get the brief and apply accordingly. Deferred tax and group scenario. Number one, deferred tax and group scenario. What does that mean? What is the background? Whatever I'm discussing, what's the background? What's the background? Background is that what, whenever you are working on deferred tax with the group, you must ask yourself with this question: what will be the effect of deferred tax in case of acquisition accounting? Bas. This is the question. What will be the effect of deferred tax in case of acquisition accounting? What will be the effect in case of acquisition accounting? Sir, what does that mean? This means, candidates, IFRS 3 says that whenever you acquired a subsidy, so subsidy is identifiable net asset must be at fair value. This is what accounting standard says. It's not for individual books. It's IFRS 3. It's acquisition accounting. It's due for acquisition accounting. So simple, very simple. What you will do? Acquisition accounting at acquisition date. Acquisition date, fair value adjustment upward. So what's the entry? What's the entry? You say that non-current asset debited and net asset. If the fair value adjustment creates non-current asset debit and it impact goodwill credit and NCI credit. Yes or no? If fair value upward, that means we have paid less expensive. That's goodwill become reduced. And what about the sir post acquisition? The post acquisition with excessive depreciation. What will be the entry? Debit credit, non-current asset credit, and CRE and NCI debit. CRE and NCI debit. So, sir, what will be the impact of deferred tax? If you increase the asset, that is called fair value adjustment. And if examiner asks you, the deferred tax, for example, non-current asset increased by 100. So, and tax rate is 30%. So what you will say that we have booked the gain and gain effect on goodwill and NCI. So if we book the gain, there should be some impact of the tax. So what will be the entry? Deferred tax liability credited and goodwill debit, NCI debit. Goodwill debit, NCI debit. That's a clear point. The behavior of deferred tax liability is same as we are adjusting the acquisition accounting. Fair value adjustment at acquisition impact to goodwill NCI. Deferred tax liability also impact goodwill and NCI. The difference is asset difference is different and asset impact is different and liability impact is different. That is called acquisition. And what about sir post acquisition? Post acquisition means 1 year has gone, asset not sold, and value deteriorate. So we have reduced the asset. If we reduce the asset, exactly the deferred tax liability should also be reduced. Deferred tax liability debit, but with same behavior, post acquisition, CRE, NCI. This is the point. This is what the point. Candidates, is it possible? Listen careful. Is it possible? Is it possible that fair value adjustment reduces? Is it possible fair value reduces? Yes, it's possible. If fair value upward, that's called deferred tax liability and reversal. But in case fair value adjustment downward, that is called deferred tax asset and reversal. Here the case about acquisition, deferred tax asset debit, goodwill credit, and share credit. It's very rare case that's examiner examine this point. Post acquisition, deferred tax asset credit, CRE, and share. That is what the group account first point. Do remember, ask yourself number one, ask yourself, what will be the effect of deferred tax in case of acquisition account. So it's only affect the acquisition accounting, not the individual books. It's already mentioned all the things here, but I am going to give you one more thing. One more thing, last thing. Sir, unrealized profit. Unrealized profit. For unrealized profit related to inventory, that is post acquisition adjustment. A quick example, a very basic example. Parent subsidy relationship 80%. Parent sold goods to subsidy. Cost 1000, sales price 1200. Inventory unsold 50%. Tax rate 30%. What will be the impact? Number one, unrealized profit. You must say that 1200 into 50% is equal to 600, and the profit margin, oh sorry, unrealized profit, it's simple. 1200 minus 1000 is equal to 200 profit, multiply by 50%. That's 100. That's all. You can work, you can calculate in another way as well. What should be the entries? Other than tax, there are two entries. Number one, revenue debit, cost of sales credit 100. Sorry, the complete amount of 1200. Number two, unrealized profit. Unrealized profit adjustment. Unrealized profit. Who holds the inventory? If parent sold to subsidy, subsidy, inventory credit. Who earns the profit? Parent, CRE. That's equals to 100. Sir, what will be the impact of deferred tax? Do you remember deferred tax impact related to unrealized profit? For unrealized profit, always deferred tax asset. Always. I'm not discussing about the reason. 100 into 30%, that's equals to 30. And it's a post acquisition adjustment. The important point is this: who holds the inventory? Inventory held by subsidy here, because parent sold inventory to subsidy. And profit of parent. So deferred tax should be adjustment with respect to subsidy. Ultimate recipient. And the entry should be in a very basic manner. Deferred tax asset debited and CRE credited. Amount 30. The principle same as you put the unrealized profit. Sir, what will be the case Sir, what if subsidy sold goods to parent with above case? Number one, all sales debit, purchases credit, same 1200. Number two, unrealized profit. Subsidy to parent, CRE, NCI, and inventory. 100, 80%, 20%. 80, 20. Deferred tax asset, the principle same. You put inventory with CRE, NCI. Deferred tax asset debited 30, that's a 30%, and CRE and NCI 80, 24, 6. That is what done. One last statement, I must have to say that. I must have to say that. In group accounts, if you need to write something for deferred tax, but one very important thing you have to write is deferred tax calculated based on temporary difference, huh? And temporary difference calculate carrying amount and tax base. Do remember that always the carrying amount based on consolidated books and tax base always based on individual books, and that creates that difference either taxable temporary difference, deductible temporary difference. Once again, whenever you are writing the answer, you must have to mention that either fair value, the case of deferred tax with group accounts, you must mention that either fair value adjustment, unrealized profit, whatever. The difference is due to arise. We are calculating the carrying amount based on consolidated books. But tax base means tax authorities. Always consider the tax base individual books. That is the reason to develop the difference, that is temporary difference. Taxable, deductible. Candidates, thank you very much about the IS 12. I cannot, you and me cannot afford to discuss more thing about the tax, but I have given you a complete platform from which you can just throw your knowledge. Read me, read this handout, whatever the written in this, that is more than enough for your exam question of the SBR. Don't go anywhere else. The next thing I wanted to start, that is IS 19. I will discuss IS 19. And after that, I will discuss the point, that's performance measurement. How to handle the performance measurement thing. But first, the employee benefit. So I think so we have to take uh, a break at that point. A quick 5 minutes break. A quick 5 minutes break. 5 minutes break. Thank you very much. I hope that IS 12 become valuable for you. Thank you very much. Take a 5 minutes break. CRE stands for consolidated retained earning. Consolidated retained earning. Okay, take a 10 minutes break. Okay, do it. Ten minutes break. Thanks. Take a break. Okay, candidates, come on. Hello. Hello, hello. Hello, candidates. Can you please reply me about your presence? Oh, great. That's good. That's good. Now start. Yes, we will discuss IFRS 9 tomorrow, inshallah. Tomorrow, IFRS 9, um, IFRS 15 limited, IFRS 16 limited, and the conceptual framework. I will do my best for all three or four. Today, I will discuss some aspect of the performance management uh, after IS 19. Okay, candidates, come on. Come on, come here, come here. Let's move quickly. A very um, interesting standard, that is IS 19. What accounting standard says that? Accounting standard says, listen carefully. Accounting standard says, whatever the employer provide benefit to employee, this is employee, other than shares, other than shares. That is the key point. Other than shares. It's a part of IS 19. Number one, short-term benefits. It's a very basic one. Short-term benefit, that is salary, bonus, leaves, termination benefit, that is the redundancy, golden handshake, and post-employment benefit. The keys, the very important, that is RBP, retirement benefit plan. RBP, retirement benefit plan. That is what the 95% of the standard, major part of the standard. Other long term, for example, maternity leave. For example, disability leave. Other long term, leave it. Post employment benefit plan. The post employment benefit plan. Post employment. Once you become retire, retirement benefit plan. You know that retirement means two things. Number one, if the age of retirement is 60 years in the company, so either before that you will leave, either leave the company or leave the world, the case of death, or at 60 years, that means the retirement, and after the actual retirement means you no more able to conduct the job, and you will conduct you are now become retired. So whatever retirement means, before the actual retirement date or actual at the retirement date, but whatever the point is, that is called a retirement benefit plan. Retirement benefit plan having two aspects. There are two possibility of the retirement benefit plan. You must have to clear about it. That is the defined contribution plan. What is the meaning of defined contribution plan? Very simple. Actually, what is the complete retirement plan? How this work? The complete retirement plan in this manner. For example, you appointed me. You appointed me. You appointed Hussain Qazi. Hussain Qazi is employee. And you appointed me, say, your salary is $100,000 per year. But the company having the policy to deduct some amount from your salary, for example, 5%. And deduct means this is the contribution of the employee. So that 5,000 plus adding on the employer some amount. Adding on employer some amount. And both of this amount invest in an investment plan. And this investment plan called plan asset. So this is the system. Over the period of time, this will grow, the plan will grow. And at the date of the retirement, the employee will entertain the or get the benefit. So that is what a system. But this system called defined contribution plan, when when this called the defined contribution plan, when that plan asset risk and reward, RNR, risk and reward related to employee. And we are here to discuss about employer. If this plan asset risk and reward related to employee, so this plan is called defined contribution plan. So we as a company, as an employer, must say that employer is employer contribution is fixed up to the employer salary, whatever the commitment that made. And the very important thing, in the defined contribution plan, employer will not record the plan asset, because plan asset belongs to employee. And the liability is very short term. Examiner can ask you to distinguish between defined benefit, defined contribution. So you have to mention that the liability is short term, risk on reward, as discussed previous slide, related to employee. But the important point is that the another plan is called defined benefit. The another plan called defined benefit. What is the meaning of defined benefit plan? The meaning of defined benefit plan is that listen carefully. You appointed me, Mr. Hussain Qazi, with the annual salary of $100,000. And you said that you have a salary of 100,000, but your contribution of 5% of salary. Listen this point very carefully. But if I ask you that, if me, Hussain Qazi, ask you that, how much yours? You reply, for example, it's none of your business. I replied that, what do you say? What I'm saying? I ask you that, how much your contribution? You replied me, none of your business. So what is my business then? You replied that whenever you will retire, whenever you will retire, you will get 1% of the final salary multiplied by number of weeks. Example, number of weeks. Means you have defined a benefit that will be calculated at retirement date. So then I ask you that, what if at the retirement date, this plan is not enough equal to this benefit? You will again reply, sir, it's none of your business. We will pay. Which means that this plan asset belongs to employer, and employee contribute plus employer, whatever the contribution annual. It's not limited. That's why the liability is long term. And that's called PO, plan obligation. So in the defined benefit plan, you have to mention the employer will guarantee the amount and have to pay extra fund if there are some deficits, which means risk or reward of the plan related to employer. So in this case, there are two possibilities. Number one, accounting standard says in the defined benefit plan, plan obligation, plan asset. Case number one, 100 plan obligation and 80 plan asset. That's equals to defined benefit liability, that is 20. We have to report on a net basis. We have to report on a net basis. We have to report on a net basis. But this one also the case. Plan asset, plan obligation, and that's 110. That's 10. And this is called defined benefit asset, but subject to some impairment test. Accounting standard says, very importantly, some important things. Number one, how to record the plan. Two things you have to report. Plan obligation, plan asset. Plan obligation is a liability. So liability means opening balance plus CSC. CSC means current service cost. And current service cost meaning, for example, 1st January 2019, you appointed me. And now the time is 31st December 2019. So 1 year has gone. 1 year has gone. So 1 year has gone, and I have performed the services. So now your liability in present value term is called current service cost. If employee spend the time in your company, and whatever the time has spent, that is 1 year. So that means employer become liable to pay them some amount. So that particular amount in present value term called current service cost. So that is what the current service cost. Like more things in this, and also plan assets. That's we are talking about. I'm working on it. Don't worry. For example, there is a situation. There is a situation. Let's take a situation. Take a complete example. For example, the time period is 2019. Time period is 2019. Fair value plan application, for example, 100,000 means opening liability 100,000. Number one, we are standing at year end. So at year end, so opening liability should be present value adjust. That is unwinding of discount. For example, 10%. And this will be used, for example, WAC. This will given to you. Amount 10,000. 100,000 to 10%. Current service cost means what I explained to you. That 1 year has gone, your liability by 1 year increase. So 1 year increased liability in terms of present value, that is current service cost. For example, current service cost in present value terms, 30,000. Benefit paid. Benefit paid means some, for example, your company has 500 employees and current year 10 employees retired and benefit paid actual retirement, and you have settled them the amount. So if you settle them the amount, for example, that's amount equal to 40,000. Sorry, 20,000. Two things I wanted to recall here for you people. Number one, you know very well in the accounting world, you required measurement, and for reliable measurement, you you will refer the uh, you must have to refer valuer in the real estate. For example, property, the real estate valuer, investment property, real estate valuer. In the case of post-employment benefit, the valuer is the valuer is actuarial. And accounting standard says whatever the accounting you made, whatever based on a opening value, based on opening, whatever the accounting you made, at the end of the day, you have to take the value from valuer. Also, based on accounting, the value become 100 plus 10 plus 30 minus 20, that's equals to 120. But for example, your valuer says that no, your liability should be 1,20,000. Sorry, 1,25,000. Suggested by actuarial. So that means you have increased your liability. It's not become 120, it's 125,000. It's very simple, huh? It's very simple. So if any increase in liability, that's called a remeasurement loss. And I strongly suggest that you people must have to know these double entries because you required some adjustment. If there is a case of current service cost, what you have made the entry income statement debit and plan obligation credit. Past service cost means change in plan. Past service cost means change in plan. And in change in plan, if liability increase, same entry. Income statement debit, plan obligation credit. Interest cost, unwinding of discount. Income statement debit, plan obligation credit. In case of expected return, plan asset debit, income statement credit. You must have to remember this entries. Contribution paid means employee contribution. Contribution, plan asset debit, and bank credit. Benefit paid. Benefit paid, that means you have to pay the amount to the employee at retirement. So from where you will pay the amount? Of course, from plan asset. So you will sell the plan asset. For example, someone retired and equal to 1% of the final salary calculation of the benefit, for example, 10,000. Bank debit, plan asset credit, 10,000. And then you have to pay plan obligation debit, bank credit, 10,000. So what will be the entry? Bank should be cancelled. Entry should be plan obligation debit decrease. Plan asset should also be decrease. That's must. You must have to know the double entries, because in ethics or other questions, something went wrong. That's you have to. Then you have to uh, rectify the errors. You will support accordingly. So let's continue with this example. For example, 2019, this one is the case. That's we are talking about. And fair value plan asset, that's, let's suppose opening balance, that's 80,000. Expected return, accounting standard says expected return based on WACC, that's 10%, 10%, 8,000. Contribution paid, not effect to plan obligation, but plan asset. For example, contribution 22,000. Benefit paid, both effect. With respect to accounting, the total value become 80 plus 8 plus 22 minus 20. That's equals to 90,000. But let's say actuarial says fair value of plan asset equal to 1 lakh. So if asset become increased, that's gain. And that's equals to 10,000. That is what the complete case. Important point is that what will be the extract? Current past service cost always charged to P&L. That's 10,000. Quick. It's very simple. Huh? Interest cost component, that's net of 10 and 8. Always net off. That's 2,000. Charge. Curtailment settlement, I will discuss later. Net remeasurement, ceiling, we'll discuss later. Net remeasurement, gain or loss. 5,000, 10,000. 5,000 loss, 10,000 gain. That's 5,000 gain. Remeasurement always to the OCI. So how much the total amount? 10,000, 2,000 minus 5,000. That's equals to 7,000. And the balance sheet, that should be reported equal to 125, 100. Do remember that that is not surplus, deficit. And deficit name defined benefit asset. Deficit name defined benefit asset. Defined benefit asset. Oh, sorry. Defined benefit liability. Deficit means defined benefit liability. Candidates, very important thing. The examiner can ask you. Here, you must have to know that planned obligation, planned asset, and net is defined benefit liability. And exam point of view, you must have to know what will be the effect of this. For example, current service cost, interest cost means return, current service return, interest cost to individual plan obligation, plan asset, and also to the net. For example, what I wanted to say to you, I must say that current and past service costs increase the plan obligation and also increase the defined benefit liability. Interest costs increase the plan obligation, also defined benefit liability. Expected return increase plan asset, but defined benefit liability decrease. Net. This is net effect. Contribution paid, plan asset increase, but defined benefit liability decreases. Benefit paid, plan asset, plan obligation decrease, plan asset decrease. Defined benefit liability nil effect. Nil effect. So that is what a quick review about a background about the IS-19. This is the background. Examiner one time already examined the issue related to the explanation about actuarial gain and loss. Why arises? You must have to explain this. What is the meaning of actuarial losses or gain? You must say that this is actually the difference between the actuarial values and asset and liability and accounting values. That's accounting values we have calculated and the actuarial measures value. And why this arises? This arises because of the reason that you have to mention this experience adjustment. That's the effect of the difference between previous assumption and actuarial assumptions right now. Candidates, if I say one thing very important, plan asset, actuarial gain or loss, actuarial gain loss plan asset. Why this arise? You must say the difference between expected return and actual return. That's all. What the expect, because we always calculate the WACC, use the WACC expected and actual return. That's actuarial gain or loss related to plan asset. But why actuarial gain or loss plan obligation? This is a number of list, number of factors. For example, what factors? The company total liability based on when someone retire and what will be the salary on retirement. So what are the factors of the salary? Salary belongs to employee. Employee belongs to company. Company belongs to industry. Industry belongs to economy. Multiple factors. Employee, the mortality rate. Company, the growth rate. Industry, the growth rate. Economy, the growth rate. In COVID-19, number one, employees retirement date, the mortality rate have changed. This is what the COVID-19 point. The mortality rate of the world have become change. So companies' liability become change. The economic situation change, growth rate change, industry rate change, company growth perspective change. Number of factors. Examiner can examine. These are the basic questions you can attempt by your own. Very important thing you need to consider. Two things I wanted to discuss with you. What is the meaning of the past service cost? Listen carefully. Past service cost means change in plan. Now, change having two things. If the situation is good, that's called improvement in plan. Improvement means your liability become increases. But past service cost change another things. That's amendment, curtailment. Some amendment or curtailment. That's liability become decreases. My first notes you can read by your own about the improvement. That's a double entry. Simple. But the important thing I need to discuss with you, not the improvement. Uh, the point is curtailment. Curtailment. Candidates, I need to discuss before curtailment. One very important thing. Once again, these things are important with respect to December attempt. That is called the restructuring plan. Restructuring examples. Candidates, restructuring examples. Yes, I know that restructuring belongs to I-37. But do you know that there are, if someone says to you restructuring, what does that mean? Something close, something relocate, business for sale, debt burdens. We need to reduce the debt burden. Our debt increasing and our covenant become breach, maybe breach. So we need to reduce the liability. That's why we curtail the provision. I'm sorry, curtail the pension plan. So connect the restructuring with defined benefit plan. If some business, some division going to close, so curtailment occur, reduction in plan. Relocate, maybe possible, curtailment. Business for sale, debt burden. You have to remember this particular point, what I'm saying, that maybe defined benefit plan is a separate element, or maybe it's part of the IS-37 restructuring. Both are possible. Both are possible. But you need to, you must have to able how to explain the term curtailment. First, the discussion of curtailment. Later on, connect with IS-37. What is the meaning of curtailments? Whatever the reason behind the restructuring, curtailment having two possibilities. And in the case of curtailment, what do you want? You want that your balance sheet defined benefit liability wants to reduce. Sir, how? How it's possible? Candidates, listen carefully. This defined benefit plan, for example, I you appointed me in a you appointed me, I'm Hussain Qazi, your employee, and you says that our company policy that to eligible for defined benefit plan, to eligible for retirement plan, you have to stay for 2 years. Once you complete your 2 years duration, then you move for, yeah, you are eligible for retirement plan. For example, the company, and you have been working with this since last 20 years, but now you have changed this 2 years towards the 5 years. The company have announced that our policy for the eligibility become 5 years. So automatically, these people who are qualified for 2 years but less than 5 years become unqualified. So automatically significant reduction in number of employees and liability decrease. One another possibility that, let's say, for example, your policy is defined benefit plan 1% final salary into number of months. You cut that 0.5%. That is qualify only for reduced benefits. You will pay but lower amount. Maybe possible the combination of both. And you have already negotiated with the employees, with your trade union, and you have already settled your legal matter as well. Don't worry about it. We are here talking that what is about the situation of this curtailment. If you only curtail the liability, if only, this is the basic example, very basic example of for the understanding. You can read it. And in fact, this is my regular class lecture. This is what called you. If this is the case of the your exam, you will mention this. The above arrangement is curtailment, since the company demonstrably committed to making reduction in the amount of benefit and the number of employees covered by the plan. This is another example. And you can read it accordingly later on. What will be the double entry? Curtailment. That's a reduction. That's called plan obligation debit. Your liability reduced, plan obligation debit, P&L credit. That's the impact. Another important point. The very important thing you have to consider here. The very, very important point you have to consider. Sir, when to recognize the curtailment transaction? When to recognize the curtailment transaction? If the curtailment is an independent event, only one thing, when curtailment occurs. But if it's possible that you are making a provision of IS 37 for restructuring, then you will use the term earlier of the dates. Curtailment or when entity recognize the restructuring cost or termination benefits, whichever is earlier. So you have to look at the case. Is the curtailment part of the restructuring plan or it's an independent? If independent, then ignore this point. Ignore if it's independent even. Next point. Curtailment done. Settlement. What is the meaning of settlement? Settlement means you are actually adjust your liability Adjust a defined benefit plan with some payments. So curtailment means only the liability cut. Here the matter of settlement. Settlement means adjust your liability by paying off the cash. You have negotiated, for example, the, you have a liability burden and you have to adjust it accordingly. So you are negotiating that some of the employee we wanted to withdraw. We wanted to withdraw with respect to some employees, and you must have to adjust accordingly. We have paid some amount to them, and that's called curtailment with settlement. We withdraw 100,000 liability and pay them, for example, 70,000. The difference is profit and loss account. But do remember, it's not benefit paid. Benefit paid means in the normal circumstances, once the person retire, you have to pay all the dues. Settlement, it's some of the part of restructuring. Negotiate with them. And in fact, you can read this from the example. Zeta and all the things. This is what the double entry. Oh, yes. SBR caliber question. Read it. This is a P2 exam question, in fact. Note down all these questions, and once the session will over, you must have to ask me. I will reply one by one, or you can ask me on the WhatsApp group. No issue at all. The following information relates to a company Diamond with the financial year end 31st March 70. Diamond operates a defined benefit pension scheme. 31st March 17, the company announced that it was closed down business division. This is some issue. And agreed to pay each 150 staff cash payment to compensate for the loss of pension arising from wage inflation. It is estimated that closure will reduce the present value obligation 5.8 billion. So, how to deal with settlement and curtailment? It's simple recording. It's not explanation matter. But I have mentioned the question with uh, a discussion. Here, the curtailment and settlement happening together. As Diamond is limiting the future benefit of the defined benefit plan due to restructuring and compensating by settling plan by offering lump sum payment of their termination. The estimated settlement provision, that's amount 7.5 billion, include in current liability. If not yet paid, current liability. If paid, okay, bank credit. And immediately due to the employees. 1.7 more than the curtailment 5.8. So loss 1.7 billion should be taken to P&L and reduce the plan or pension plan obligation 5.8. This one is the double entry. This one is the double entry. Simple. No issue at all. Now, candidates, wait a minute for this point as it's sealing. One moment. Yes, this is a question. That's a question attached. Read it. That is specimen 2. Read it carefully. It's not the part of current handout you have. I will share you accordingly. Please read it carefully. That is how the examiner can examine. There are 3 things that IS 19 is examined to you. One time with the ethics, one with the current development of IS 19. I will share you the handout for the current development. Not enough time for discussing it. If possible, I will discuss tomorrow, but not sure, not promising. That's already examined. Now it's not become the current development. Okay, candidates. Business segment restructure. Kachin has decided to restructure one of its business segment. Decided. Plan was agreed by the board of director on 1st October 6. Affects employee in 2 locations. Okay. In the first location, half of the factory unit have been closed by 31st December XX. Your year end 31st December XX. Huh? And affected employees' pension benefit has been frozen. Any new employees will not be eligible to join the defined benefit plan. And after restructuring, the present value of defined benefit obligation in the location 8 million. Present value of defined benefit, 8 million. Following tables relates to location 1. Present value defined benefit obligation 10. Fair value plan asset 7. Net pension liability 3. In the second location, all activities been discontinued. Agreed that employees will revise payment of 4 million in exchange for the pension liability 2.4 million unfunded pension scheme. Kachan estimates that the cost of the above restructuring, excluding pension, will be 6 million. Kachan has not accounted for the effect of restructuring financial statement because planning a right issue and does not wish to depress the share price. Therefore, no formal announcement of the restructuring. No formal amount of restructuring. Examiner asks 2 things here. Discuss with suitable working how pension plan scheme should be dealt after restructuring of the business segment and whether provision of restructuring should be made in the financial statement. 2 different things. Number 1, provision of restructuring. You must have to well aware of IS 37 that since F7 you have been we have you have been studying that restructuring plan, business restructuring provision can be made if at the reporting date where you are making the provision, either plan already implemented or formally announced. You know very well about it. Here, plan not implemented, no, and even not formally announced. So here in this case, provision of IS 37 cannot made. Provision of IS 37 not made. Yes, but the issue about the defined benefit plan, location 1, location 2. So first of all, the important point is that after the restructuring, one by one, the location 1, after the restructuring, the liability become 8. Defined benefit obligation, that's become 8. And if I say that location 1 is only curtailment, but the second location, the agreed employer will receive payment, some payment to the employees of the exchange of the unfunded pension plans. So that means curtailment with settlement. So two different things. So you can just work out accordingly. Here the heading is missing. You will mention that IS 19 and here the IS 37. It's very simple. Restructuring the present value pension location reduced to 8 million. And this is, you must mention that this is only, you must mention that this is only curtailment with the adjustment of 2 million, whatever. And location 2, there will be a settlement and curtailment. And you have to mention these two entries. You, I must say that you can answer better than this solution by heading location 1, that is curtailment, location 2, curtailment settlement, make a description and put the double entry. You can draft much better than this one, I must say. And this 137 you can read accordingly. Okay, candidates, one last thing I wanted to discuss with you about IS 19. One last thing, that is asset ceiling. Candidates, listen carefully what I'm saying to you. If this is the case, listen carefully what I'm saying to you. Very important concept. 2018, 2018, you have calculated actuarial gain and loss, plan obligation, plan asset, overall, opening, current service cost, past service cost, opening, here opening, interest income, all the matters, here ending balance. But here ending balance plan obligations shows 1 lakh and this one 1 lakh 10,000. And you are working on, listen carefully, in the regular class you just skipped some points. Income statement, you have already charged service cost, that is current past, interest cost, all returns and unwinding, all curtailment, in fact, OCI, remeasurement, gain or loss, state But in a statement of financial position, you are just working plan obligation 100, plan asset 110, and 10,000 is surplus. You have already done all above. Surplus means you are going to add the asset. You wanted to, in a statement of financial position candidates, you wanted to enter defined benefit asset. Can we add this defined benefit asset 100,000? Answer will no, never. Because either deferred tax, either property plant equipment, whenever you are going to enter some asset on the accounts, you are going to enter some assets on reporting, you have to about test about what? The expectation of the future benefit. The expectation of the future benefit. Accounting standard says that, listen carefully. Accounting standard, let's take an example. Accounting standard says that if this is the case, at reporting date, fair value plan asset suggested by actuarial 950, fair value pension liability 800. So that means it's surplus or surplus of 50. Sorry, surplus of 150. But what amount you will report on defined benefit asset? Before reporting to defined benefit asset, you have to test that this surplus should be compared with this matter, present value of future refunds and reduction. So reduction in future contribution 70. If this amount is less than this amount 50, so there is an adjustment need to made. That's called asset ceiling adjustment of 80. And this should be charged to OCI. And what will be the entry? The entry will be defined benefit asset credit and OCI debit. That's 80. And the defined benefit asset must be 70. Defined benefit asset must be 70. Yes, if this amount 70 equal to 160, then no matter it is, asset ceiling adjustment only arise if surplus greater than present value future reduction and contribution. It's just like impairment test. Candidates, I hope that you got this point. A quick review about it. I will add on one more question. Although asset ceiling question is already mentioned, but I will add on one more question. Like um, I will mention in this handout. You can work out accordingly. So candidates, now this is all over the IS-19. I hope that it's you got a good review. Uh, related to this matter. Accept about IFRS 16, COVID-19. No, not yet examined, and it's not even because syllabus have changed, but it's not mentioning that they will examine the IFRS 16. Uh, I will share a video, a short video on the YouTube. You can that's all of, it's not about the ACCA, it's also about the CA students, so you can watch the video accordingly. If in that case it's examined, you can um, handle accordingly. Otherwise, I don't think so that that matter examine in December, maybe in March. Yes, in ICA. There is nothing about the expectation which accounting standard will examine. Examiner can examine anything with the matter. Okay, before discussing the matter of the um, performance measurement aspect, I must say that we have to take a short break about that because you people have just reviewed the 19. So make a quick break of the 5 minutes. 5 minutes break. 5 minutes break. Then I will discuss the matter about it. Hello. Assalamu alaikum once again. Hello. Please reply me. Hello. Oh. Okay, let's start once again. Okay, candidates. The very important point for your consideration. Bismillah ar-Rahman ar-Rahim. Sir, how to examine the performance measurement? How the performance measurement examined? Okay, candidates, here is a total list that I can say that the examiner can examine. This is the total focus area. This is the what focus area. If you wanted to prepare your SBR with respect to the performance measurement, you must have to follow this sequence. That's all, not more than that. This is the total scope. This is the total scope. Although in the revision session, I cannot discuss all the matter in the full detail, but as max as possible, I'm going to discuss it. Number one, the performance measurement, one aspect related to the ratios aspect. Ratios not like F7, but accordingly, one by one, EPS, cash flow analysis for performance measurement. One by one, this list, I'm going to discuss the list accordingly. Number one, if I say that the performance measurement ratios issues, so then important point is that it's not like F7 ratio interpretation, but we cannot ignore the basic formulas. But we cannot ignore the basic formulas, especially the basic formula related to investor. Investor are very much concerned. Some important point. If I say that investor, so investor concerned ROE, very important. Investor concerned ROCE, very important. Investor concerned EPS. Examiner categorically mentioned that they will not examine the dilutive EPS in detail here. That was a part of F7. But EPS can be examined in another way. In another way, I'll discuss accordingly. So the point is that investor concerned ratios are these. But other way around, some important GP margin, net profit margin, operating profit margin, that's you can work out accordingly. Return on capital employed, the special one. That's specifically for the equity holder. The basic formula, return on capital employed for overall investor. The basic formula, operating profit, capital employed. But we can also spread asset turnover because profitability based on asset turnover and operating profit margin. It's better that you can get marks for a quick explanation, because one time examiner has asked you explain the ratio for 1 mark. That was return on equity, maybe for return on capital employed. So it's simple. Return on capital employed is a financial ratio that can be used to assess the company's profitability and efficiency. And it's the ratio is based on how much profit margin and how well the asset can be utilized in the system. So it's basic. And it's based on previous studies. You know very well the split of return on capital employed. Same that return on equity. Return equity particular for equity holder. Profit after tax divided by equity. And this profit after tax divided by equity, that's particularly the return equity ratios measure the rate of return with the respect to owners of the share issue. So how much the company generating the profit for its shareholder. But you know that profitability based on profit margin, that is net profit margin, asset turnover, and equity ratio. Asset turnover means how well we are utilizing the asset in terms of revenue generation. And equity ratio, that's asset over equity, means your total asset is split in long-term finance, either debts or equity. So how much total asset belongs to equity? That is called equity ratio. If you mix all three, that's equals to profit after tax divided by equity. That's basics. Other ratios like long-term stability, financial gearing, interest cover. An examiner has already examined this financial gearing matter on uh, ethical question as well. So you must not make up your mind that performance measurement means something very structured. It can be examined anywhere in the paper. So liquidity ratios never examined. You can read it like this. Uh, to develop your mindset, one basic question that we can discuss here. One very basic question. We will discuss one exam question as well. Starling has issued B class shares, recorded them equity instrument under the statement of financial position. Under term of the shareholder agreement, Starling obliged to redeem shares in cash in 3 years' time. Aha! This is the B class shares, equity, but you have an obligation to redeem shares. So, should it be equity? No, that should be the liability. So, accounting, your examiner can ask that what are the accounting implications and the performance measurement aspect. This particular statement I have copy paste from the examining team handout. Don't forget, the SBR exam require candidates to adopt stakeholder and investor focus and answer the question. Very first day I've already mentioned this. So if examiner this one, then we simple split this answer into prospect, accounting implications, and financial performance. Investor perspective. You must have to make an heading. Financial instruments should have been classified financial liability and contains obligations to transfer cash. So this means equity overstated, liability understated. What investor viewpoint? The error will improve the gearing ratio, which may lead investor to underestimate the financial risk. This is what the investor perspective. If we show the wrong picture, gearing will be undermined. That's investor risk perspective is not considering the right way. And if equity is higher, what investor think? More expectation about the dividend. EPS already overstated. That is what the point. Candidates, whenever you are reading the notes, so once you reach at this point, You must have to read this article. You must have to read this article, please. At that moment, that is the important thing you have to consider. That's have to read the article. And after that, you have to attempt these three questions. I am I have mentioned the sequence, huh? You have to work out with these questions. One of the question like this. One of the question that we have already discussed very first day. Like this. This is the September, December 19 questions. You don't have the handout. Uh, should I share with you? Of course, you wanted. September, December 19, question number 4, part B. Guidance company. This part, some part of this question already discussed. But now, today, I am discussing with viewpoint of the investor. Considering the financial result for the year end 31st December XX. Industry places great reliance on ROE as indicator. How well company shareholder fund to generate the profit. This is what the point. ROE. So here the examiner pick one ratio only. That is ROE. And that is spread in three parts. All three parts. Profit margin, asset utilization, asset turnover. That's we discussed earlier. And they have given you table last 2 years figures. All these. And one thing, one by one, there is an issue of special purpose entity. You remember that? I've already discussed this point, special purpose, with the reference of the case of Enron. That's, I said to you that group accounts, it's not just part of only section A question 1. It can be the part of anywhere in the question. We have already discussed in ethics. We have already discussed in performance measurement. Number 1, special purpose entity. Then miscellaneous transactions. One is buy back the shares. Buyback IFRS 9. Then raise loan capital. Then purchase 25% associate. And said that this one is correctly worked out. These are the accounting transactions, including a special purpose entity. And what examiner says, listen carefully. What examiner says, all of these missing, all of these miscellaneous transactions have been accounted for in the financial information for the year 31st December X6 in table 1. Means this miscellaneous transaction in table 1 already incorporated. Now the question, discuss 5 marks. The usefulness of ROE ratio. Number 1. That is the straight thing. Straight. Just make heading usefulness of ROE and describe it. And its component parts provided above. This is the this is what very simple. It's the most easy part of the question. And calculate the ratios 35x566. Most simple part, simple straight. These calculations should be based on information in table 1. Means no need to adjustment. Just take the figure and calculate. And now another part. Discuss the impact of setting up SPE. I have already discussed in the earlier class. And miscellaneous transaction have had on ROE and component parts. Given these consideration adjustable table 1 and recalculate the ROE X6 comparable for the X5. And mention that professional marks will be awarded for clarity and quality. Whatever the clarity quality means, you have to sequence your answer. Whatever examiner asks, you have to split accordingly. Candidates, are you getting the point? How the ratios are examined in F7? Oh, sorry, SBR. Can you please reply me? Hello. Sally, you asked that what probable to come for December. If anyone knows in SBR what probable to come, then we have to focus accordingly. Yes, definitely. Ratio type number one for all performance measurement. You can refer my notes. No issue at all. How many marks? Listen careful. If you ask that how many marks for 12 marks, listen, for 12 marks, here the 12 marks. 12 marks, huh? Discuss the impact the setting SPE and miscellaneous transaction that have an ROE. Listen here. Number one, I've mentioned it. ROE and relevance of investor, 1 mark. Related to component, 1 mark. Calculation, 1 mark. And if you comes to the B2 application, setting up, that is 12 marks on total. Setting up special purpose entity, 2 mark. Miscellaneous transaction, 2 multiplied by 3. Each have 6. So how much the marks? 2 marks, 6 to 8 marks. And for calculation, that's 4 marks. I have allocated all the things, candidates. You just work out accordingly. These are the very structured answer belongs to equals to your exam caliber. If you are sitting on the exam and you are working for 12 marks, how much to work? First, you have to plan a special purpose entity. I have 2 marks. And one more thing, I wanted to say that. One more thing. If you are planning to write SPE for 2 marks, your mind should develop that I have to mention 2 points over there for 2 marks. Number one, the knowledge of IFRS 10. Number one, knowledge of IFRS 10. What IFRS 10 says, that application. And number two, connect with the case. Connect with the case means the special impact on the asset turnover or the ratios, whatever examiner asks. Same for miscellaneous transaction. Number one, you mentioned that 2 marks. So buyback shares. You should develop your mind. I have to put 2 points over there to buy back the share. Number one, buy back the share. It's right there. So two things is what? Number one, decrease the equity. And then investor perspective. This is misleading indicator. Everywhere. 2 marks, 2 points. You have to split your mark accordingly. Are you getting the point how to answer the questions? Please reply me, candidates. Oh, Hafiz Saab, don't worry. I am busy engaged here to deliver. How can approach to the WhatsApp? Don't worry, you will get all material there. Just after the um, session, I'm a human being, not the machine. That same time, I'm working on the WhatsApp as well. Please, yaar, I have got your point. I will definitely add you. Don't worry there. That is the point. Okay, candidates. So you have to work out accordingly for this type of solution, for all solution. These are very precious solution for you. Should I hand over to you in the free of cost? At least a gift I need to require from yourself, from you people. At least a small gift from your side. Okay, move on. It's a lockdown situation for the education center. Okay, move on. The time is rushing out. Huh? Listen carefully. This is not over. This is not over. Candidates, listen here. Uh, I will extend the class for 10 minutes. Please, please, please be with me. Don't go anywhere. This is only about, this is only about the ratios matter. You have to put this from the sequence. Huh? Furthermore, sir, how the EPS can be examined? Although EPS not yet, EPED haven't examined in detail till now. Examiner has mentioned that the DEPSL calculation is ignored. Huh? The calculation working is ignored. But assessment of EPS, it's important. Like what will be the impact of the EPS ratios? And examiner can ask EPS limitations because investor can compare one company EPS with another EPS may be possible. The choice of policy, the choice of policy, the choice of policies, for example, one company use the property plant equipment by cost model, another company by uh, fair value model. So that's creates inconsistency or EPS is not comparable. Maybe this type of equation affects. And this example, it's very clear to develop the mindset. Example to develop the mindset. How EPS can examine. You have to read accordingly. I'm not here to read it working. You have to read it. This question is very much important, but this is not an exam question. This is not the exam question. This is just for mindset. This is just for mindset. Yes, sir, cash flow. Candidates, also I can say that in a normal trend, whatever examined in the last semester in the group accounts, normally not exact the major question part related to same semester. But it's a very rare chance that in question one, cash flow will examine again. But it doesn't mean that you ignore it. You have to spend at least minimum time because unfortunate situation may arise. Okay, but cash flow can be examined as performance measurement tool. You know very well that income statement, balance sheet, and EPS and other related ratio ROC, ROE, it's based on income statement, balance sheet. But the investor want more than that. That want more than that, like cash flow issues and projections about the cash flows, especially in COVID-19 situations. Based on the current year, 2019 COVID-19 situation, the cash flows, the operating cash flows, that is regular, financing and investing one off. So investor wanted to evaluate the situation, what will be the projections in term on future, the company's future operating cash flows expectations, because dividend is based on cash flows, it's not based on profitability. So you must have to develop your basic mindset. These are the examples. That is the operating cash flows and investing, all these financing. And you must have to attempt this question, cash flows, at this point. Furthermore, examiner can examine what this state. This is very much important. An examiner has already examined this. I will conclude my lecture with this example. Listen carefully what I'm saying. This is pure theoretical and something analysis as well. But impact of policies and estimates. You know that accounting standard, the terminology standard means uniformity. Two companies, for example, you are an investor and evaluate the position A and B company, wanted to invest either A, either B. And you know very well that they both applied IFRS. Though they both have applied the IFRS. IFRS means back of the mind, you say you have a perception that both use the standard accounting, but IFRS given the option of flexibility, the policies A and B can use the, for example, investment property and property plant equipment cost model, revaluation model. So if they are using two different models, so actually the accounts are not standardized. Same, the flexibility in terms of choice of policy and choice of estimates. This is current development as well. That's IX 8. You have given the freedom to for the estimations. For estimation, there should be standard guideline. Like fair value measurement, there are some standard guideline of IFRS 13. So estimates are open-ended right now. Judgments open-ended. So one company basis of judgment is different, another company basis of judgment is different. That is the point. So first you have to read this, a basic example to develop the mindset. First of all, that's different basis of estimates, impact on ratios. This is not ratios only. That's examiner expecting that you have to discuss the aspect of estimates and not to standardize the things having impact on investor perceptions. Then work out this investor analysis, work out accordingly, and have to attempt these questions. Have to attempt these questions accordingly. Candidates is like this. One sample I can view that. One minute. I'm just going to end this. Yes, like this. Read it. Examiner examine in this manner. This is very generic. 6 marks. Management's intent and motivation on fun influence accounting information. Means me as a director, my intention and my motivation impacts on the accounting information. Definitely. If I have an mean if I have a choice, listen carefully. If I have an intention to exaggerate the profit for any purpose, ethical matter, for personal benefit, my intention, and I have a choice of accounting policy, so I will be successful to report the account with respect to my own interest, rather than if there are no option to select, there are no option for the sorry, for choice. So my intention not reflect to decide the accounting policy. So definitely this statement is very deep. However, corporate financial statement necessarily depend on estimates and judgments. Financial statements are intended to be comparable, but their analysis mode the most accurate way to judge the performance of any particular company. This lack of comparability may be due to different accounting policy choices or deliberate manipulations. Discuss reason why entity may choose accounting policy when IFRS allows accounting policy choice, and whether faithful representation and comparability are affected such choice. 6 marks, two things. Number one, why accounting standard allow you. Number two, it will impact the faithful representation or not. Three marks. For each 3 marks, you have to put at least two or 2.5 points. It's very generic. I don't have time right now. Otherwise, I will put the deep analysis for this, but you can read it accordingly. Candidates, thank you very much for this today's session. I will try my best to choose and pick about the IFRS 9 for tomorrow's session. Choose and pick the IFRS 15 and IFRS 16 matter with conceptual framework. With conceptual framework. One last thing, if I have time, I will discuss with you. I'm not promising you, but I will give you the document. The remaining part of the performance measurement, especially the non-financial aspects. Non-financial aspects. So candidates, thank you very much from my side. I hope that with this limited time and the huge giant syllabus of the SBR, and you have limited time of next 12 to 13 days, you are getting benefit from these sessions. Your confidence is now increasing from this. If no, do reply us. If yes, please give no, or yes, please give a constructive feedback. Please give a constructive feedback on the WhatsApp group after the leaving the session, on the platform, whatever. And if you have any question, do ask me. I'm available for next 5 minutes. Thank you very much. Jazakallah khair. Please do uh, give the feedback of these sessions. Yes, for ethics matter, whatever the material I have shared, the topics I have covered, that's more than enough to consider, to conclude, especially for ethics and the performance measurement. I will share the performance measurement on the WhatsApp group, the solution part. The curtailment aspect can be examined again. Yes. Yes, it's possible. Defined benefit. I will share you by next 1 hour the all of the day 4 material on the WhatsApp group. Don't worry. As norm. Can you please send me one more time uh, the message, a WhatsApp message? I will add you accordingly. Once again, please. Okay. Thank you. Please share us the constructive feedback about this session if you are getting the benefit. Thank you very much. I will try my best to be to provide to best solutions and best answers. Even reply to you after the P2P sessions. Don't worry about it. Ramesh, if you wanted to know more thing about the IS-19, do contact me on the WhatsApp group. I will share one thing more about IS-19 on tomorrow, inshallah. Our priority is that to provide you the best material or best solution which you can pass it. It's not about the knowledge there. It's not only about the knowledge. It's about how to decorate the knowledge on the examination. That's important. The bridging the gap between the examiner expectation and your performance. Thank you very much. Tomorrow agenda will be IFRS 9, IFRS 15, 16 with conceptual framework. Straight. Allah, may Allah bless you the success. What a human being can do, only one thing, the best efforts with honesty. Success, failure depends on Allah. May God provide success to all of you. We only here for the success. We only here for the purpose of the efforts. So put your efforts, do your efforts. It's all about the life. Inshallah, we will qualify. About technical articles, I will uh, particularly mention on tomorrow in one document. Don't worry. Extensive notes of the IFRS 9. Oh my God. This is not, I think so that now at that time it's not to prepare new thing. It's time for the revision of the things. It's more time for, it's a time for the revision. It's more about revision. Yes. Inshallah by Sunday or Monday I will share for the tax reconciliation. That is that was unusual. The examiner examined the tax reconciliation unusual. Don't stress that. You cannot say that if you don't know about the tax reconciliation, you will disqualify or you will flunk with the IS with the um, exams. Not possible. Even the examiner examined the tax reconciliation. At that point, students not attempted well, but qualify that example. One important thing, do remember. I will discuss this point tomorrow as well. If something hard, if something hard in the examination hall, you will not flunk, you will not fail based on that particular uh, uh, concept or issue that examiner examined the hard one. Because the hard is the deliberate part and it's for all. Examiner will only count that how well you effort for this hard element. That's all. Even if you do the wrong thing, examiner will not fail you. But if you mess the things based on that hard element, you nervous and based on that nervousness, uh, based on that panic, you attempted even the easy things in a wrong manner, then examiner will definitely fail you. About a special purpose entity, that's um, the first day that the group accounts pocket notes includes all these things. Oh, cryptocurrency, not promising, depend. By the way, tomorrow session I will extend by 20-25 minutes more. Huh? That's why I will extend the tomorrow session. Okay, then candidates, thank you very much. Take care a lot. And Allah Hafiz. Rest of the point, inshallah, next tomorrow. Thank you. Thank you very much. Take care. Thank you very much. Thank you. Assalamu alaikum. Assalamu alaikum. Don't worry. Don't mess with the exam solution. There are 40%, sorry, there are 50% chance you will qualify. There is so much flexibility in SBR. Don't worry. Okay, thank you very much. Take care a lot. Assalamu alaikum, everyone.